Step onto any trading floor or log into any modern brokerage app, and you are joining millions of highly educated, rational people. Yet, year after year, everyday professionals who excel in their careers consistently watch their portfolios bleed red. The immediate instinct is to blame a lack of financial literacy, or perhaps one catastrophic miscalculation on a trendy stock. But the data tells a different story. Losses mount because investors treat the market as a series of puzzles to be predicted, rather than a system of value to be assessed. Without realizing it, they turn the act of building wealth into an unwinnable game of guessing what happens next. By attempting to outsmart the daily, hourly, or even minute-by-minute fluctuations of the market, retail traders are forcing themselves to play against the house. The mathematical odds of continuously guessing right are permanently locked against them. Look at this short-term stock chart. These sharp movements aren't patterns, they're random noise. But occasionally, you bet right before a massive spike, landing a lucky guess. Your brain then releases dopamine, a chemical reward identical to pulling a winning slot machine lever. This neurological response is addictive. A single stroke of luck generates a surge of confidence, providing the chemical fuel to justify 10 more impulsive bets. The human brain is wired to find meaning where none exists. By misinterpreting random volatility as a solvable puzzle, an investor gets locked into a compulsive loop, where the ceiling for long-term success is effectively capped. This predictive loop demands constant feeding. You wake up and scan headlines. By noon, you adjust limits. By 3, you're staring at charts, debating whether to liquidate half your portfolio. This framework visualizes your cognitive endurance. The gauge represents your capacity for rational choice, which drains throughout the day, causing decision fatigue. Every news alert or tweaked position burns this battery. By late afternoon, processing slows, the framework fractures, and emotions take over. Once emotions dictate the trades, your discipline collapses. You start selling off healthy businesses simply because the share price drifted lower for 48 hours. Then the anxiety kicks in. You watch a trending ticker fly up the boards and throw capital at a company you haven't researched, purely out of a fear of being left behind. And when those impulsive bets crash, instead of cutting your losses, you hold on to bleeding positions for months, waiting for the market to eventually prove your original prediction right. The careful strategy you started with at 9 a.m. is eroded by a dozen minor choices throughout the day. By the closing bell, the focus has shifted from data-backed plans to simply reacting to the stress of the moment. It is easy to point fingers at the frantic day trader. But long-term investors frequently fall into a more deceptive version of this exact same trap through implicit predictions. You might spend hours projecting next month's earnings or modeling exactly when an industry will hit an inflection point. It feels rigorous, but strip away the spreadsheets and it is still a guess about an unknown future. True research doesn't ask when will the stock price jump. True research asks, is this core business model sustainable? It evaluates the integrity of the management team and measures the durability of the company's competitive moat over a 10-year horizon. Obsessively tracking quarterly misses creates a dangerous illusion. You fall into a state of tactical busyness that masks a lack of strategic depth. Masking a short-term guess with the language of research creates a layer of intellectual certainty. That certainty makes it harder to admit a mistake, often leading investors to double down on a losing position rather than reevaluating their thesis. Escaping this cycle requires a complete rewiring of your approach. You have to stop asking the market what will happen tomorrow and start asking the balance sheet, what is the baseline value today? This visualizes a prediction-free framework. 3 vessels, stocks, bonds, and cash, are filled by a steady flow of capital over time. This is dollar cost averaging. As markets move, an automated rule trims any overflowing excess and redistributes it, buying into other assets while they are cheap. This mechanism succeeds because it's blind. It doesn't read the news, it doesn't care about earnings whispers, and it completely ignores where the market might head next week. By removing the need to predict the future, you neutralize decision fatigue at the source. The heavy lifting is done by a mathematical structure, leaving no room for emotions to sabotage the process. Successful investing functions as a long-term partnership with a profitable business, rather than a test of how quickly you can process market data. If you want to succeed, you have to drag your eyes away from the minute-by-minute glow of the candlestick charts. Sit down, open a single annual report, and figure out how the company actually generates its cash. Stepping back and doing less feels wrong in a culture obsessed with speed. But the same slow, persistent pressure that allows a glacier to reshape a landscape is what drives long-term portfolio growth. It relies on duration rather than speed. The stock market does not reward the sharpest predictor or the fastest trader. It is a mechanism that ultimately transfers wealth away from the impulsive gambler and into the hands of the patient system builder.